Hello and welcome to this week's episode. It's great to have you here and I'm delighted to welcome award-winning journalist Robin Powell as my guest today. Now, Robin has spent most of his career in mainstream journalism, where he has worked in broadcast news, current affairs for ITV, Sky News and the BBC. As he considered where to take his career next, Robin stumbled across passive or index investing and became fascinated by this lesser-known investment approach. Since the 1950s, there has been a lot of research into the best way to invest, and the findings have been remarkably consistent. Yet very few people seem to follow the evidence. Via his blog, The Evidence-Based Investor, Robin aims to inform investors about what the evidence says and what makes for a successful investment experience. In our conversation, he explains, first of all, what evidence-based investing is and why he believes so strongly in this approach. We also have a discussion about risk and volatility and how they shape this investment philosophy. And we also discuss Robin's new book. I hope you enjoy my conversation with Robin Powell. Welcome to the Retirement Cafe podcast, Robin Powell.
Well, thank you very much. Looking at your recent guests, I'm very honoured to be considered among that elite, if you like. Thanks for having me.
Well, I've known about you for a long time, Robin, and the great work that you do. But of course, you're here today to talk to me about your brand new book, which I think literally came out a few days ago. We're recording this on the, I don't know, where are we?
25th of October.
25th of October, and I think it came out last week, did it?
It actually came out on the 28th of September. It's Invest Your Way to Financial Freedom.
Well, this is a topic close to my heart, obviously, and as a financial planner,
I'm sure it is.
And I'm sure a lot of the I know a lot of advisors listen to this podcast, but also a lot of retirees listen to this podcast, and maintaining their financial freedom, of course, is hugely important. And also they see their children and their grandchildren. They want them to be financially successful. So. How did you come about, or tell me a bit about your background for those who don't know you, to get to the point of writing a book?
Right. Okay. I mean, to be honest, I'm not a financial advisor. I'm not a financial professional. I haven't worked in the City of London or anything like that. I'm a journalist, and I wasn't even a financial journalist. I did a little bit of financial journalism latterly at Sky News during my television career, but I was, about 25 years in television, mainly with ITV, also with BBC, the politics show, and with Sky News, as I say, you as you get older and you sort of start to develop a face for sort of radio and podcasting. So, sorry, that's no reflection on your own appearance today. But as you get older, you kind of look for things outside of television. So I set up my own production company, and I was approached by a wealth management firm in Birmingham called Barnett Ravenscroft Wealth Management, and they were very into this passive investing. I don't like to call it passive investing anymore because I don't think that's a particularly helpful kind of name for it, if you like. But I was interested in it. I was very skeptical about it, and I set about interviewing lots of very clever people, journalists, authors, academics, including Nobel Prize winners, and leading industry figures, not just in Britain, but all over, and particularly the United States. And I was blown away, to be honest, that there is all this evidence out there about how to invest, and yet the vast majority of us don't invest that way at all. And worse still, and I'm sure this is something that grieves you as well, Justin, there are lots of financial professionals who are actively encouraging people to invest in the wrong way. That really bothered me. I've done other projects in the last 10, 11 years or so since I did that documentary, but I've pretty well been focusing 100% on that.
Yeah, wow. So, let's just unpack that a little bit. And obviously your book
kind of does this, but explain what passive investing is and why that term doesn't really work.
So, passive investing, I mean, I suppose why it doesn't work, it's not a great marketing phrase, is it? No one, no one likes to think of themselves as passive. We all like to think of ourselves as active, as doing things, as making a difference, if you like, rather than just letting things sort of happen to us, if you like. But actually, that's not really what passive investing is all about. I prefer to talk about index investing or evidence-based investing, and broadly speaking, evidence-based investing is about not investing based on your beliefs or your hunches about what might happen to the economy or to the world, this sort of global situation, climate change, and particularly the financial markets, because the financial markets, like the economy, are extremely hard to predict. It's very, very hard to predict. Index investors, evidence-based investors, if you like, invest in index funds which just simply track the entire market, and you're expressing no opinion as to whether one stock is underpriced or another stock is overpriced or whatever. You're literally going with the market, if you like. And the beauty of index investing is A, it's simple, B, it's cheap as chips. There are some funds which are more expensive than others, but you can literally find index funds which are less than 1/10 of the cost of actively managed funds once you factor in transaction costs and things like that. And the other thing is, you're actually harnessing the power, the intellectual power, the information, the evidence of the whole market. That's thousands and thousands of people, including the experts, all over the world. It's like a giant supercomputer. It's like having that giant supercomputer on your side. And actually, if you look at the data, very, very few professional fund managers over meaningful time periods are actually able to beat that giant computer. So I'm quite happy to be an index investor.
Great, wise words, and I predominantly invest in index funds myself, and sometimes weight my clients' portfolios to areas where we hope to have, or history has shown that we've had a higher expected return. But again, huge diversification, and I would say even the things which aren't pure indexes are still allocated to the smaller companies, maybe, or to the value companies that history has shown us to give us a greater return, again, over the long term. Not trying to predict, not trying to tell the future, but just looking back at that past evidence. So for the average investor, he goes, okay, I've got to get the index fund. But of course, actually, there's more to it than that, isn't there? There's the choice of maybe getting into an index fund, but it's actually, well, how much do I put in? Where do I put in? What am I trying to achieve? You unpack lots of these ideas in the book. Give us some takeaways around that.
As I said before, one of the advantages of index investing is its pure simplicity. It is simple. It's not easy to do for reasons we'll probably go on to discuss, but it's simple. Having said that, as you say, there are a few things that you need to think about before you start. This book is primarily aimed at people in their sort of, I suppose, any time from sort of 18 upwards to sort of late 30s, something like that. And I know your audience, Justin, is largely sort of slightly older than that, and but I would actually say that we should all be taking an interest in educating young people about encouraging them to budget properly, to save, to get some savings behind them, and to start investing. I actually think it's one of the most valuable things that you can do for your child or for your grandchild, alongside giving them happy memories of childhood and getting them to exercise regularly and eat nutritious food and so on. Just helping them to get set up financially is a really, really important thing that you can pass on to the younger generations. So in this book, what we really wanted to do was explain, just in simple terms, the things you need to think about. And to be honest, there is not a fat lot. Particularly if you're just starting out as an investor, you've obviously got to think about the risk that you're taking on, because it's not risk-free. Shares can go up and down really very, very quickly, but there are ways of minimizing your risk. Obviously, investing in an index fund is one of them. So, if one stock plummets, then that's just a tiny bit of your portfolio, if you like. And to be honest, for most investors, young investors, they need to be 100% invested in the stock market. Now, I will qualify that by saying, if you've inherited 250 grand from a grandparent, or you've won a lottery or whatever, lucky you, but don't suddenly put it all in the market in one go. That's not necessarily a good idea. But what you should be doing is looking to invest 100% in equities on a regular basis. So put something aside today, then in a month's time, another month's time. And as we say in the book, make it like your Netflix subscription, automate it. So it just goes out of your account, so you don't even have to think about it. And as I say, for the vast majority of young people, they need to be 100% in equities. I suppose the only exception to that, Justin, I'm sure you'd agree, is if you really, really want to get on the housing ladder, for example, and you're saving a deposit or whatever, you've got to bear in mind that that if obviously markets fall 30, 40%, which they could do, I'm not saying they will, but they could do, that you could suddenly be sort of left quite a lot short on saving for your deposit.
Yeah, and of course, if we look back at history, we see a 30% decline, every 5 or so years, and in fact, most years have a 15% decline within the year. Well, we haven't had that for the last couple of years, but obviously, but again, it is history. But one of the things one of the questions I have for you. So even the word risk, I think if you put that out to most people, just the word, you've got a risk with your money. Straight away, that makes most people back off. And in fact, I often talk about the analogy. We've kind of morphed into this last couple of hundred years of this financial system that we work with. But actually, if you look back thousands and thousands and thousands of years, when we stepped outside of our cave with my twin brother, and I heard a rustle in the undergrowth, and I legged it, and he went, "No, don't be so stupid, Justin," and then he gets eaten by whatever was in the bushes. Risk, the being scared, helped me, didn't it? It kept me alive, and therefore this whole statement about risk is like, well, okay. How do we quantify this risk? Because I would wonder, is it risky, really?
Well, you've quite rightly raised the issue of human evolution and how human beings are very, very finely attuned to immediate risks, but things which we need to think about, things that over the long term, for example, we find it very, very difficult to sort of calculate those risks, if you like. The modern day equivalent in 2021 of the saber-toothed tiger in the African savannah or whatever. So you don't get tigers in Africa, you get them in India, don't you? But anyway, you know what I'm saying. Lion. The equivalent of that today is running out of money. Is having to rely on charity, your family, loved ones, or the state, which may or may not be willing to help you, to pay for your basic financial needs in your 70s, 80s, 90s. And as we keep reading, yes, longevity has actually gone down a little bit in recent years, But I tell my kids, you know, they're going to live to, you know, they look after themselves. They're going to live to 100, you know, maybe more. And, you know, that's a long, long time without being in work to, you know, look after yourself. And that's the biggest risk we face, or young people face. There's a very good financial advisor who I'm sure you know, called Andy Hart, and he talks very, very well about risk and volatility and this kind of thing. And he's, for me, come up with the best way of describing it. There are essentially 3 types of risk. One is completely losing all your money. And if you think about it, you could do that on the stock market. The stock markets could go down to 0. If you're in an index fund, you know, the value of that fund could go down to 0. It's extremely unlikely to happen. If you're invested in Bitcoin, for example, that could easily go down to 0, and you know, at any time. And derivatives, or, you know, risky investments like that. But if you're invested in a low-cost index fund, the risk of that happening are minimal. The second type of risk is inflation, and we're hearing a lot about inflation at the moment. You and I remember, well, I remember, you maybe not, just in the 70s, where, you know, every time you went past a petrol station, and I noticed today, actually, petrol prices at their highest ever, you know, they had to, there was always someone on the ladder changing the sort of price of the petrol at the top, and that was inflation. And we forget, because we've had such low inflation, how serious that can be. And that is like a sort of, it's like a sort of steady sort of leakage of your financial wealth. And, you know, if you're not earning more than inflation on your money, on your investments, then you're effectively getting poorer, not wealthier. But the third type of risk, and this is the one we associate with risk most often and talk about most often, is volatility. And actually, volatility is the one flavor of risk, if you like, that you really shouldn't worry about, because volatility really is just a reflection of what people think today about what companies are going to be earning in the future and what the stock market's going to be returning in the future. And that might change tomorrow, it might change next week. There's just no way of telling. The best thing is to accept that risk is part and parcel of investing, and just hang on in there for the long term.
Absolutely, absolutely. And I often talk about, you know, we to my clients, we're invested in 11,000 odd different companies. And if you really take that to heart and say, well, 11,000 odd companies who have got a value today, and they've got a value today because they have expected profits. People are buying those companies, the shares or the equities in those companies, because of that expected profit. Now, absolutely, some of those companies will disappear. You know, in my lifetime, I mean, I always talk about, you know, blockbusters. You know, they were on every high street across the world, and they're no longer to be seen. We're seeing a lot of retail companies disappear. You know, I've been an Amazon customer, you know, since 2006. They tell me, you know, and all you could buy was a book. You know, so everything continually changes. But the idea that there's permanent loss of all the wealth of all of those companies, those 11,000 companies, that they implode and disappear forever, seems to me to be, you know, frankly ridiculous. And alternatively, even if you think that that is a possibility, then where else do you hold your money? Because, by the way, the shares that you're holding in 11,000, those are those banking shares as well. Those are those insurance companies. Those are those utility companies. They are those supermarkets that you own. They are the Amazons and the Apples and the Googles and everybody. But the idea that they're going to put those companies, their future earnings will disappear forever, then with all honesty, the world has imploded at that point and gone to hell in a handcart, and your value of your pension fund is probably going to be the least of your worries.
Well, exactly. I mean, I suppose we're in sort of meteor strike territory, or nuclear war, or something like that. But actually, even if you think about that, I mean, it's unlikely, but it could happen. But let's just think about it. Humans are amazingly adaptable, and they adapt to change very quickly. And when you invest in the stock market via an index fund, you are investing in human enterprise, and people will always need to make money to, just simply to sort of clothe themselves, put a roof over their heads and so on. They will always have to go out and make money. And as long as, children are being born, babies are being born into the world every day, I mean, that is going to carry on happening into the future. So, yeah, even if there was a calamitous event, then there would be some sort of recovery. You clearly, if a meteor struck, I'm sure our index funds would take one massive hit as well. But it's not all over if something like that happened, as long as humans survive.
Absolutely, and if you go back through the history books of what the indices have done, and just take the S&P 500, since the late 20s has compounded at a rate of around about 11% a year. I mean, it's quite amazing. And what do we had? We've had the 30s crash. We've had World War II. We've had 73, 74 oil crisis. We've had Vietnam War. We've had 87 crash. We've had the dot-com bubble. We've had the credit crunch, and 9/11, and now the pandemic. And as long as you sat in your chairs, you would have received a very handsome compounded return.
Yeah. And it's actually another way to look at those kind of events is, and horrible though they are in terms of loss of life and in case of wars and so on. But as far as an investor is concerned, you are rewarded for the risk that you take throughout those events. And actually, really very, very brave investors are people who invest when it looks absolutely grim. And there are some sort of passive investors, index investors, evidence-based investors who disagree with me on this. But I actually say, if you do have some spare money to invest when things are really grim, go for it. I mean, I've got a couple of sort of young adult children, and last March, 2020, the markets absolutely plummeted very, very quickly. And I just thought, heck, there is one massive buying opportunity here. I am as surprised as anyone, Justin, at how high markets are. I had no idea that they would be at the levels that they are today. But I just said to my kids, when the markets had fallen 30 to 40%, go for it, start investing, and, just put, £1,000, my son had to invest. So just put it in a Vanguard 100% index tracker. And I'll tell you what, the next day, I think the market lurched another 4%. And I felt really guilty. And I thought, oh, crikey, he's lost £4 there or whatever. But then, or for £40 if it was 1,000, whatever. Yeah. But actually, he is massively quids in. He thinks I'm an absolute genius. I keep reminding him I'm not. I had no idea that things were going to, recover at quite the pace they did. But ever since, every month since March 2020, he's been putting money in. And I tell him not to, but he goes onto his Vanguard account and looks at how much he's made, and he's absolutely thrilled.
Yeah. It is the only thing that we're not compelled to buy when it's on offer, aren't we? It's
everything's on sale, so we all keep out the shops. Yeah.
Absolutely. Now, one of the bits in the book, which I must admit, I thoroughly enjoyed all 22 chapters. But the one little element I want to pick you up on and discuss a bit further, is target dated funds. These are the funds for people who are not aware. They're pension funds or investment funds that basically have a you say, look, I think I'm going to take this out when I'm 60, I'm going to take it out when I'm 65, what have you. This is when I need the money. And what it's trying to do is trying to get you into an investment vehicle that will allocate it and de-risk it as it gets closer to the time that you're going to take out of the money. Now, you in the book, it sounds like you're a fan of these. I'm not such a fan of these. So let's chat about this.
Well, that's absolutely fine. I mean, one of the really, really important things that we want to get across in the book is that investing is really quite simple, and it's as simple as you want to make it, really. And if you want to make it really, really simple, then a target date fund is an option. I know what you're saying, and I partly agree with you as well. If you've got more time or you want to sort of look into it more, then do so. But actually, to set a target date fund and say, right, I'm going to retire in, whatever it is, a young person today, 2065 or whatever, and everything sort of works to that point, if you like. It's sort of slightly different for people when they get to your age, maybe more to the point my age, where you actually probably will want to carry on investing well beyond your retirement anyway. So actually, maybe a target date fund isn't ideal for those people. We just wanted to say that, okay, it's not perfect, but it's good, and the perfect is the enemy of the good, isn't it? And the most important thing, frankly, is to start investing, because you can always, change it at a later date if you want. But no, I take your point on target date funds.
So, just to get my perspective across, the reason I'm not a massive fan of them is that actually most people, if they get to 60, have probably got hopefully 20, 25 years ahead of them that they're going to need that capital to continue beating inflation, growing in real terms, so that the money they can take to Sainsbury's or the supermarket of their choice keeps continually growing and continually to buy the same basket of goods, or even maybe a better basket of goods. Therefore, we need to stay invested throughout our retirement. But where I do see this working, and it's an interesting one, because I know that the Nest pension scheme, which is of course the government the government endorsed auto-enrolled pension scheme that basically everyone can have access to now. There are plenty others available, but one of the largest schemes in the United Kingdom, the Nest scheme, has a very, very low risk kind of fund for the early years, and then it starts moving into equities. Now, I look at that and I go, well, that's nuts. We need to get them into equities from day one. But I also understand the human psychology around this, is that what they don't want people to do is suddenly go, I've been in 2 years and I put in my 8% of salary has gone in, and my 250, 300 pounds or whatever is in there has now fallen by 150 to, it's halved in value because the equity market has gone. And they don't then view that as a good deal, and they get out of the thing, when actually, of course, that's probably the best thing that could have happened to a 20-year-old. So there's a whole thing, and I know your book is great at doing. There's a whole thing around the psychology, and it's not so much about getting the best return; it's about having the best behaviour.
And it's about habits as well, habit forming, and habits are really, really important in terms of getting where we want to in life, and it's getting in the habit of saving, the habit of investing. Actually, what we not wanting to give away everything in the book, because we want people to go away and read it or buy it for their children or grandchildren, but one of the really important points we make is that before you start investing, you want to save, and you want to get about 6 months of income behind you. And once you've got that cash cushion, then you can afford to start taking risk, inverted commas, and absolutely go for it, 100% equities from the start, knowing that as you say, if markets fall, well, actually, if you're a young person in the early years, that's a really good thing. See, my kids, they think the market goes up all the time. So, they're in for a heck of a surprise when it doesn't. But hopefully I've warned them about that, not possibility, but that, that certainty, if you like, that it's going to happen. But actually, it would have been better for them, in fact, for the markets, in a sense, to have not done as well as they've done over the last sort of 18 months.
Yeah. And it is very easy to fall into this kind of recency bias, isn't it? Which is, if you talk to an Argentinian about inflation, they've got a whole different view of inflation than we have. And when I trot out sometimes some of the lines, the average inflation in the UK has been 5.7% per annum since 1955, and people look at me and go, really? Because, of course, over the last 10 years, they haven't experienced anything like that. So they didn't think this is normal. And, of course, because anyone buying a house in the last 10, 15 years thinks that interest rates of 2%, 3%, 4% on their mortgage is perfectly normal. Now, you and I tell you what it was, mine was 13.75%, and of course, so it's also this understanding, isn't it, about how the different figures relate, and maybe a little bit of history is a good thing.
Yeah. And also, I would say as well, people getting on the housing ladder today, they can't remember a house crash. Housing crashes are horrendous. They break up marriages. I remember the sort of 89 crash. I suppose that's when I started to have friends sort of slightly older than me, admittedly, buying houses and getting into terrible negative equity and being thoroughly depressed and worrying whether they'll ever be able to buy a house again. We've got very short memories. We need to remind ourselves of what's happened in the past.
Absolutely. So the message I'm hearing, and the message I want to pass on, I think, to our listeners and to the watchers on YouTube, is, when we think about investing, probably the first thing to do, the first investment you should probably do is buy a book like yours, because actually, if you can make, if you think, well, I'll just spend a little bit of money on your education around the subject, that then it probably is the most beneficial compound thing that you can then do. Because if it can stop you making some mistakes, that by the way, I have been guilty of over the years. I got heavily involved in the .com internet stocks.
I've been there, done that.
And it took me a long time to realise that evidence-based investing was the way to go. But actually, in investing a bit of time to understand how this all works, understand what's going on with your pension, understand the kind of tax opportunities that are available to you. For the younger person in the UK, they've got lifetime ISAs, they've got ISAs, they've have had child ISAs. They've got all these different types of things, and spending a few pounds on some education and an evening's reading it could significantly benefit them.
Yeah, one of the, I mentioned one of the huge benefits, and possibly the biggest benefit of indexing is the cost. It is so much cheaper than sort of active management, and we completely misunderstand the impact that fees can have over the long term. If someone doesn't read this book and goes out and buys all the sort of active funds that are recommended in the Mail on Sunday and whatever newspaper, I shouldn't pick on one particular paper, but pick up any financial publication, that there'll be expensive active funds in there that have done really well over the short term. But, will we have heard of them in 10 years' time? Will they still be in business in 10 years' time? Most of them probably won't. By indexing, you can literally save yourself in today's money, if you're starting out today, hundreds and hundreds and hundreds of thousands of pounds by indexing as opposed to, using supposedly clever active fund managers. You could honestly buy another house. You could honestly buy another house with the money you save, the difference in fees, because you still have to pay for index funds. Obviously, they're not free. There is actually a 0% index fund in America. We don't have them here yet, but you do pay a little. But the difference is absolutely vast. And sorry to sound like a salesman, but for the cover price of the book, you are going to save that, gazillion times over, basically.
Absolutely. So, in your opinion, then, do youngsters need financial advice?
That's a very good question. I think everyone would benefit from financial advice. Everyone. And in fact, when I was young, my problem was something we address in the book, of living beyond your means. And for me, it was actually someone at my local church, actually, who very kindly looked after members of the congregation like me, who sort of struggled to make their sort of salaries fit all all their outgoings, if you like. He just sat down with me and said, right, here are all your outgoings, here's your income. Can you see what the problem is here? That's the most important thing that young people can do, is to make sure that they're living within their means. They're saving as much as they reasonably can. Obviously, they've got to enjoy life as well. We're not killjoys. My co-author and I, you've got to, have holidays and fun nights out and so on as well. But save as much as you can. And the more you invest in the early years, the less heavy lifting you'll have to do when you get to my age.
Absolutely. Well, Robin, I've thoroughly enjoyed chatting with you this afternoon, and I highly recommend your book, Invest Your Way to Financial Freedom. It's thoroughly worth a read, and for younger and for older investors, I think they'd gain a lot from it. So we'll put links to it in the show notes. We'll let people know how they can get hold of you, where they can speak to you, etc. Maybe even drop you an email and tell you some of the success stories they have from reading the book. So thank you once again, Robin Powell.
It's been a pleasure. Thank you.
Thanks once again to Robin for chatting to me today. To find out more about Robin, index investing, and his new book, Invest Your Way to Financial Freedom, head over to the show notes on our website at theretirementcafe.co.uk or on your preferred podcast player, where you'll find some useful links. Be sure to tune in next week to hear the incredible story of Kevin Webber, better known as Dead Man Running, and his ongoing journey with prostate cancer. Remember that if you prefer to watch my conversations, you'll find them all on my YouTube channel, which is Justin King MFP, and you'll find a number of videos, a whole series of other videos to help you plan for and live a successful retirement. So until next time, I'm Justin King, helping you feel more informed in your retirement.